Hello, I'm James Kirby, Wealth Editor at The Australian, and welcome to The Australian's Money Cafe this week. Interesting week, I have to say. I think at least the share market's looking very toppy, I have to say, at the moment, and some of the more wild speculative activity out there is really fascinating, especially with crypto. A lot of the new startups, or at least the IPOs, also very interesting. Canva, that amazing Australian company, is now worth more than Telstra. And it isn't even listed on the stock market and has no plan to do so, which is an interesting development in the sort of what they still call the unicorn space. House prices, of course, rolling along in all cities, and perhaps, big $1 million question, will house prices actually go up even more once the lockdown ends and people can inspect? Or will they actually soften because supply will come on the market? A lot of questions around this week around that sort of thing. I've got someone for you this week I haven't had on before. Don't know why. It's high time I did. It's an old friend of mine, and it's Rudy Philippek Van Dyke, who is the editor and publisher of the FN Arena stock market information newsletter for self-directed investors. Hello, Rudy. How are you?
Hi, hello, and I can assure you now, losing my virginity here is not such a bad thing.
Well, you don't know that yet. We've only just started. Now, folks, if you don't know Rudy's website, have a look. I have to say, straight up, I use it all the time, especially in two ways. Once I use it, obviously, for my work, and also if I'm buying a stock. Personally, from my SMSF fund, I'll always, no matter what I've done, I'll always go to FN Arena and have a look and see what are the brokers saying, how many buys and sells are on this, and what are people saying. It's a great window into what they're thinking across the market. And Rudy himself, who regularly contributes and writes in The Australian, is also very good on the market. And I want to ask you one big fat question, Rudy Philippek Van Dyke. Do you think the market is as toppy as I think it is? We are in the danger month of the year, September, the worst year historically, the worst month, I should say, right back to 1928. What do you think?
Yeah, that's what you get with those seasonal patterns. If you want to be really, really, really precise about it, then historically the worst period is from mid-September to mid-October. And usually, the reason why September then gets a bad rap and October doesn't so as much is because it sort of ends in the middle of October, and then we often get a big rally to the upside, and then into year end.
Okay.
But James, with historical patterns, the problem is that they don't repeat every year, and they don't return always in the same way as they do on the statistics. For example, I recently looked, because obviously I get these questions as well from subscribers and from investors. If you look at the past 3 years, see last year, this time last year, we hardly had a blip, a little bit of a pause, and after that the rally just continued.
Oh, did we even have a blip last September? I don't remember.
The year before, however, we had a noticeable retreat. But again, after that, the market simply continued its rally, and the year before that, however, we had something serious brewing, and it led in the US to ultimately a minus 20% drawdown by December, and Australia escaped from the minus 20% only because we responded a little bit later to the downside.
Right.
So there you have 3 scenarios of the past 3 years for September, October.
Yeah.
And if I had to express a preference, I think a repeat of last year would be just fine. Thank you.
Why? What is it about? Is it about the northern winter? Is that it? Winter is coming? Is that what it's all about psychologically? Is there any theories out there as to why it does have such a rocky history, and all the great crashes, of course, October 87, the great crash, 1929, is it all in this period?
I think because of the October crashes that the October month has a bad rap, essentially, because you will find that if you take out those crashes, October is actually not that bad for assets.
Yes, you were saying they often recover in the further end of the month.
And the other thing is I think it's simply because we're human. And that's how we humans, that's how we operate. We all get scared at the same time and we start anticipating the same thing. And once we believe there is a pattern, then by default, we probably will have a pattern.
Yeah.
And people always blame computers and seasonal patterns and everything. I always bring it back to us being humans. And that's why we sometimes see those patterns. Having said so, this year, it has to be pointed out, this year there's probably a good reason why we are keeling over a little bit in September. It's not only have we had 11 months of pretty much uninterrupted gains in the share market.
This is in Australia alone. This is in the ASX.
Oh, it's also in overseas as well.
Yeah, okay.
But what we are seeing in the background is that we are seeing a slowing down in the global growth momentum. And that is traditionally, if you want to look back at history, that's traditionally a time when investors become more cautious, understandably so, and when also risk assets usually don't perform very strongly. And this is also a reason why maybe for the next 5-6 months, maybe, we should all be a little bit more cautious because we don't know yet how quickly and how strongly that deceleration in growth will exert itself.
This is global GDP growth.
This is in particular, we've seen quite a noticeable slowdown in China happening, and the indications are that is by far not finished.
Yeah,
and there's a good reason. There's a good point to put forward that the US is now slowing as well. So that China has preceded the US, and if that is the case, then this will go on for quite a while.
Right.
And this means also in Australia, for example, what we've seen in August was actually quite important. In August, we saw for the first time in 11 months that earnings forecasts for the market in general are now in decline, and that hadn't happened for 11 months. So one of the reasons why the share market has performed so strongly is we had 11 months of ongoing increases to analyst forecasts for corporate profits and dividends.
Right.
Now, that is the longest stretch we've had in Australia for at least since the 1980s.
Oh, and this new softening of those forecasts, they're for what, 2 years out?
Well, they're therefore, for starters, for the year out.
Yeah.
And not necessarily for the year after that, but for the year after that, the expectations are not very high.
Right. So there's a sense that it's as good as it can get. Is that really what?
For the time being, that might well be the case. Yes. But having said so, I also believe, and this is why I'm probably less, let's call it less cautious than you are. We also have a big carrot hanging in front of the market. And I also always believe that when you dangle a big carrot in front of the market, that it's unlikely to have a severe correction. And the carrot this time around is that we as a community, that the lockdowns and the slowdown on the basis of COVID, that is transitory, to borrow a term from the central bankers. So we are basically, as a community, we're looking forward
to springing back.
Yes.
Yeah, to getting back out there.
And I think that's a big carrot for the markets. And as long as that carrot is there, I think we are very unlikely to have a big sell-off.
But this carrot, this anticipated rebound, isn't it the case that a lot of the economists say it's not going to be anything like the first one? That there was this big rebound the first time because everyone had never experienced a lockdown. Now we're all getting kind of battle weary, and maybe we won't go out with quite the same glee after these lockdowns as we did the first time.
I know that, but at this point in time, that's not the point. It's like when you're a little kid and you're going to have your Santa Claus presents. Yes. The anticipation sometimes is much more exciting than actually seeing your presents. And it won't necessarily be different in the share market, of course. The reason why people are now positioned in the likes of Webjet, Flight Center, etc., is on the expectation that the borders will open, and those share prices will quickly price that in. If then subsequently it turns out that we are not en masse buying airline tickets, well, that is for something that we'll worry about later. But at this point in time, it's the anticipation. And that is sort of what keeps the share market from going, I think.
So as we remain in lockdown, we remain in anticipation and they remain up. Is that it?
We're not necessarily always rising, but there's another element as well. And this is, I have sometimes a little bit of a different way of how I observe the share market and how I see things happening. But this share market has been for quite a number of years extremely polarized. And you will see that the momentum can sometimes go completely into, let's call them the cyclicals and the value trade. So you will see that the banks rally alongside the miners and the energy companies. And then on other times, you will find that the healthcare companies with the utilities and the supermarkets are rallying while the other ones are not. So you have a very strong polarized market. My theory over the past few years has been that we haven't seen a big sell-off, because what the market does, it simply switches momentum between the two extremes in the share market.
Right.
So the corrections are actually happening underneath the surface. And
as the big switches happen, is that it?
Yes, and you will find on occasion that, for example, a Woolworths is down 15% or so, and you wouldn't notice it when you're watching the index.
Yeah, because it doesn't pull the market with it. Yeah.
Similarly, Fortescue, BHP, Rio, they are down 20% before you know it. But you wouldn't know if you're watching the index.
Right. Look, that's really interesting. I see where you're coming from. And it's certainly an explanation. It is an explanation for the fact that we have, apart from obviously April last year, which was extraordinary, we haven't really had a correction in the conventional sense of 10% plus for some time. And 11 months consecutive ASX growth. What did you say? That goes back to the 1980s, is it? Since we saw such
it is the longest stretch we've had since at least the 1980s.
Yeah, amazing.
Because most data that we can look backwards upon in Australia doesn't go beyond the 80s.
Doesn't go beyond. In fact, it's hard to get anything. 85 thereabouts seems to be it, doesn't it? Okay, I'm going to cross and we'll take a break and we'll hear from this week's sponsors, Rudy, and we will be back to read some questions. Hello, everybody. Welcome back to the Australians Money Cafe. I'm James Kirby. I'm the wealth editor at the Australian. And this week in the hot seat, I have Rudy Philippek van Dijk, who is, of course, the publisher and editor of the FN Arena stock research service, which is going for some time, going for at least a decade, I think. I remember it starting, I remember the early days, Rudy, and very popular with investors who want to see and want to know what the rest of the market is thinking. And you can see it collects all the calls, among many other things, it collects all the calls that the brokers are making on different stocks and their settings, and their brokers report synopsis there of what each stock is. I found it very good for mid-cap stocks that don't get the sort of coverage, the big coverage that big media gives the market. Okay, now I'll read the first question and then you'll read the second one, Rudy, and we'll alternate. Here we go. James, this is a question from James. What are the effects of increased government debt on investment portfolios? Should we be lobbying our government to deleverage to safeguard our investments and the broader economy? If so, at what point? Yeah, well, getting investors to lobby the governments to deleverage the market so that the market will drop perhaps when that extraordinary money printing boost is gone is probably unlikely, James, but you're on the right track. I mean, there is an artificial element to the fact that share prices are so strong right now, but that is not restricted to the market, I think, Rudy. It's across, we're talking about house prices. It's all driven off low interest rates, would you think?
Yes, and I also think that investors always underestimate how the world changes. And I think there's a fair point to make that if you keep bond yields low for a prolonged period of time, the world literally changes in front of you. And you can talk. We can talk about government debt in particular, and I can point out here that globally, the approach to government debt has changed. Previously, economists and politicians and investors were very much focused on the fact of how high that debt was, and a very popular way of measuring it was debt compared with GDP. But in recent years, that has completely changed, and now the focus is on the cost to service the debt. And this is also one of the reasons why all the worries have disappeared.
Yes.
Because with incredibly low bond yields, governments can service today's debt and actually can take on more debt, which is exactly what they've done over the past few years.
Yes, yeah.
If you take that a little bit further and you include corporate debt and household debt, then of course we are at all-time high. Right? But again, we have to take that into account against the background of incredibly low bond yields. Now, the worry that constantly turns up in media is like, what will happen if bond yields go back to where they were? I think that the phrasing of that question is wrong, because I think the fact that we have so much debt by default means we cannot go back in bond yields where we were, because we basically would destroy the world, and it's that simple. So if you want to answer that question, is what's the impact of all that debt on our investment portfolios? Well, number one, lower for longer in terms of bond yields.
Yeah. Do you think they can never go back to 4 and 5%?
No, I wouldn't say never, but if we come into an era, which is quite possibly over the next 10 years or so, where bond yields have to go back up, I think we all have to wish that that's a gradual and slow process, and it probably will be.
Which the central banks will do everything to smooth out.
Because I think we all have to realize, if that is not an orderly process, then we will have mayhem in other places.
Yeah, right. And I suppose, yes, and these tapering tantrums are just sort of like mini versions of the potential sort of disturbance you would get if rates flew up as they used to, and as they did at various times, like this 80s when Paul Volcker came in and shot rates up. If you did that now, my oh my, it was trouble then. What would it be like now when we're all geared up to the eyeballs, especially with our homes? Now tell me, are you ready to read a question from Ruby?
Yes, it's only a letter difference with my name, so I can easily do Ruby. With my accent, I'm not even sure whether we do James and Ruby.
Actually, and in my introduction, I should have said, asked to let people know where you're from originally. Originally, where you're from?
Originally from Belgium.
Belgium. It's a Belgian accent, folks.
And then everyone says, like, I don't know anything about Belgium. And I go, like, where do you think Waterloo is?
And they say, I've never thought about it. Somewhere in England. Okay, exactly. Right.
Everyone always says that. Where do you think Waterloo is? Anyway, the question is as follows, and I think this is quite apt, actually. Question from Ruby to Rudy. I'm always hearing about quality stocks, but I can't find a list of them anywhere. Can you give me some examples? And I think when I see that question, of course I can, because you're talking to someone who has made it his quest almost to find quality post-GFC in the Australian share market. And I specifically have dedicated my own research to this. And one of the reasons why investors can't just open up the website somewhere and find quality stocks is it starts with the fact that there's no general definition of what is a quality stock. Everyone has a little bit of their own definition in finance.
But give us a very schoolboy definition now. Something like what would be like.
My definition, the one that I have developed over time, is basically a company that delivers shareholder value no matter what, no matter what the circumstances.
So it never lets you down.
It never lets you down.
Okay.
The true stock that you can have in your portfolio, put in the bottom drawer, And 5 or 10 years later, you look at it and you go like, I am so happy I have this one in my portfolio. And admittedly, we don't have too many of those companies on the stock exchange.
I'm very tempted to ask you, do you include the banks since they skipped dividends?
No, I would definitely not include the banks.
Is it because they skipped the dividends that time?
No, I think banks are intrinsically cyclical. Banks have had a golden time in Australia, which was also helped by the fact that Australia is an island and it is more difficult for foreign banks to come here. But most importantly, I think one of the big trends that is happening in the background is that we have this generational change through technology happening, and the banks are absolutely laggards in that field. And I believe that this is one of those elements that will show up gradually for a long time, and then all of a sudden things will go really, really fast.
Like a Square coming in on.
Yes, for example, I've been very fortunate. This morning I saw a survey done by the Financial Times, and basically the conclusion was that banks are not ready for the future. And this is globally and of course in Australia as well. The banks will essentially face an existential crisis.
If they're not, who is? Because traditionally people would say the banks, supermarkets, and then individual stocks. So who are you thinking of these days?
Oh, I would include the supermarkets.
You would still, yes. Yeah.
But more so Woolworths than Coles. If I talk about high quality stocks in the Australian share market, I think the two highest quality stocks, probably without competition, are CSL and REA Group.
Right.
And people will see that if you look back the past 15 years or so, the investment returns are nothing less than phenomenal. For stocks that are never trading on a low PE or a high dividend yield. But you also have to think about companies like a Cochlear, a ResMed, a Car Sales, Seek, that type of companies, and those are. And Amcor, for example,
the packaging,
very much underappreciated.
Packaging group, is that who you think? AMCO or Amcor? Yes. But they were a blue chip for a long time. They were very highly regarded 20 years ago.
Yes.
And then they shrank and they did big spin-offs and they sort of shrank themselves. But I think is it Ken McKenzie originally kind of turned them around, didn't he? The guy who's now chairman of BHP. Yes, can I ask you on what about Sydney Airport? Now, that's a blue chip. Most people think it's a blue chip anyway. It's always regarded as one. It's a very steady payer in many ways and a damn good stock if you're in there in the early days. And that's been taken off. It looks like it's going to be taken over by a super fund or a combination of super funds, and it's just going to be taken off the market. Do you think that's a bad thing when super funds or anyone else takes a big blue chip stock off the market?
It is a winner take all approach. It does make the Australian share market poorer. I agree, because I mentioned earlier that the world changes when you have extremely low bond yields for a very long time. Those particular assets, and you can also include Transurban and the likes, they become very highly, they're highly appreciated all of a sudden, and they become very rare because we have multiple airports in Australia, but none of them are listed outside of Sydney Airport.
Yes.
And of course, we are now going to lose Sydney Airport. And of course, those pension funds will do well out of it. But it is no longer available to us unless, of course, we put our money with those pension funds.
Yeah, but it's gone as a blue chip stock. It's gone off your little list there. Just one last thing on the blue chips, because it's very interesting. Could you explain to listeners, is there necessarily a scale issue here? Do you have to be a certain size to be a blue chip?
The answer is probably yes.
Is there a number you have in mind?
Because if you are a mid-cap or a small-cap company, then your size is working against you in doing what an Amcor can do or what a CSL can do.
Would it be? Is it $1 billion market cap? Is there something? Is there some sort of?
I'm not sure whether there's a particular cutoff, but it's more into. There actually isn't, because for example, in my research, in Ansell, which is a lot smaller than MCOR is, but it has a lot of the same characteristics as MCOR, also performs well, but it comes with more volatility because it's a smaller cap stock.
Yes.
And if you go further down the food chain, you have a technology stock which is called Technology One, which equally has similar characteristics, but it is quite small in market size and also in daily volume. So that means the volatility will be a lot higher.
Right.
But nevertheless, if you bought Technology One 10 years ago and you have it today in your portfolio, you'll be waking up with a big smile on your face every single morning. And that is, of course, what those companies are supposed to do.
Yes.
And to give you an example, I recently had a discussion with some people on social media about whether the proposed merger of BHP Petroleum and Woodside Petroleum would be beneficial to Woodside shareholders. And my question or my response was very simple. We are talking about a company whose share price on a net basis hasn't moved since 2004.
This is
Woodside.
Woodside. Not bad, yeah.
So it's the same level today as this in 2004. Now, luckily for shareholders who held on, it pays a dividend.
Yes.
Otherwise, there is no movement whatsoever. Of course, share price has been a lot higher. I know that, but this is why, in my view, Woodside is not a quality business. It's way too cyclical, and the energy sector, by the way, is by far the worst performing sector globally and in Australia over the past decade.
It's interesting. Maybe sometimes the market demands that there's a blue chip in every sector. So they look at oil and they say, well, it's not Oil Search, right? Because there's exposure to PNG, etc., other things, sovereign risk. It's not Santos because they've got a desperate history of accidents and various cock-ups, corporate and on the ground. And so they say, oh, well, wood chip is the blue chip. Woodside is the blue chip. So maybe that happens sometimes that just by virtue of elimination, they're the least worst. But as you're saying,
I think, James, I think the whole concept of a blue chip has lost its value, so to speak. I think once upon a time, there was this, under different economic circumstances, I have to say, there was a belief that a market capitalization, if you were large enough or you were the largest in a certain sector, then you deserve to be held in a portfolio for that particular reason. Good balance sheet and size. But I think times have changed, and that whole concept of blue chip, I think the sooner Australian investors throw it overboard, the better for their performance and for their strategies.
Okay, interesting. All right, now we're just going to take a quick break and we will be back. There's two more questions. Hello and welcome back, everybody, to the Money Cafe, the closing segment. I'm James Kirby, wealth editor at The Australian, and I'm talking to Rudy Philippek van Dijk, who you heard earlier is the editor and publisher at FN Arena, and very, very good on the Australian stock market. And so I'm going to read a question from Dominic, and then you could read the last one from Todd, Rudy. Dominic says, I'm starting to get into the stock market a little deeper than just ETFs. And I want to know how to do due diligence on companies before buying them. As an aspiring solar farm developer, I'm specifically interested in renewable technology. There seems to be a lot of websites out there, and I would like to avoid them, but I can't quite tell which is which. He means bad websites, which of course we don't know any of those. We wouldn't have them on the show. All right. To the question, I imagine this is happening regularly, Rudy. Someone comes in, they don't know anything at all. They buy a couple of ETFs. ETFs go well. They say, hey, this is interesting. Where do I go from here? How do I start? How do I make my first choices?
Good. Yeah. I think when I see a question like that, I think start with history. And why am I saying that? I mean, history never shows you the way forward, but history gives you very important clues. And for example, I'm a very big fan in making a difference or dividing the stock market in different baskets of stocks. And that means that, like for example, in this case, he is obviously looking into the future, but he's looking in very young technologies, which by definition means very young companies. And some of them
renewables,
some of them, even if you look into, for example, rare earth metals or other lots of strong metal. Those are very small industries with very young and small companies, and often they hardly have anything out of the ground and more in the ground. And that means that you will get these very fast and sharp cycles. And that means that if you buy them at the wrong time, you could be sitting on quite sizable losses. So it's not as
like
easy as to say,
or cobalt or whatever, they can fly up and fly down.
Exactly. It's not as easy as to say, but we will all be driving electric car in 10 years' time, so I'm going to buy lithium stocks today. That's not how these things work.
Yes.
So I think you start off by getting a broad picture and dividing why, for example, is a Orocobre not the same as a BHP, and why is BHP not the same as CSL or CBA?
Yeah.
And once you understand those differences, then I think you can start looking into individual companies and putting your money in individual stocks. That would be my advice.
Yeah, no, it's great advice, and try not, instead of taking on hundreds of companies, try and whittle it down to perhaps 3 or 4 that start to come within your criteria, and watch them for a while and get to know them, and then make your move, Dominic. Okay, the last question. Actually, if you can see there, Rudy, do you see the question from Declan? That's just. Would you like to read that as the last question?
Oh, I can do Declan.
Very good.
And I like Declan's word choice, by the way. He says, "I can't for the life of me." Maybe I should say that with an Irish accent. I can't for the life of me work out why Dusk. That's a company called DSK, by the way.
It's Dusk Group.
Dusk, yes. The guys who sell candles and such is trading so cheaply! ! And to be honest, I mean, we have more than 2,200 companies listed on the stock exchange, and I knew of the existence of Dusk, but it's not a company that I regularly pay attention to. But I had
broker reports on it, or is it?
Yes,
is it?
Exactly. So we have no. It's not covered by any of the brokers, but I have some historical data because they only listed last year. And on the basis of those data, I must say, it actually looks quite good, just the financials.
Yeah.
And it would look quite cheaply. Now, there's two possibilities here. And one is, that's why I always caution investors. If it looks really, really cheap on the share market, you always have to question why is there something wrong somewhere?
You don't believe that it could be undiscovered? Yeah,
that's the second possibility, and that is well possible since this stock only IPO'd last year. So it is well possible that it simply hasn't been discovered by the broader market yet, and it maybe is put in a basket with the likes of Temple and Webster and Kogan that are not necessarily always performing well, have some headwinds this year, and maybe it still has to prove itself.
Yes.
And I don't know at this stage which scenario is the most likely one, but I do know the answer to this, and it is the better you know the companies that you invest in, the more confident you can be that probably scenario number 2 is the one to stick with, and that you will simply have to be patient before the market picks it up.
Yeah, you said it would seem. We never give personal advice, by the way, Declan. I'm sure you know that. It would seem they're damn good numbers. It's on and then it's on an 8 times PE, which is like less than half.
Yes.
What the rest of the market's on.
So if you look at the financials, I would totally agree. But at the same time, I do know that there are many other stocks that look good on the financials, and then turns out that they're actually value traps because the market sometimes doesn't believe it, and then sometimes correctly so.
Yes.
And the other thing, of course, that the financials only give you a little bit of a sniff of the real situation.
Yes.
You really have to know the company and what's happening inside and what's coming out of it.
Are they hit by lockdowns? To what extent are they online enabled? Are they run by one person who's totally in charge of everything and is a sort of erratic dictator, or are they run by a very competent board?
It's all possible.
Yeah.
Or maybe they can't get their candles over from by container anymore.
Yes, it's a funny one, but hopefully that helps, Declan. I hope it helps. We don't even have any brokers reports to even echo to you, so we'll have to leave it at that. But normally we would, and we would always try to find them, but they're simply not out there. And Rudy would know because he monitors that whole situation. Okay, everybody, well, look, thank you very much for listening to today's episode of the Money Cafe. I'm delighted with the questions. They're rolling in. Keep them rolling in. All sorts of questions. And if you have suggestions, who you'd like to hear, what you'd like to talk about, send it in. Love to see it. Okay. You know the email, moneycafe@theaustralian.com.au. Thank you very much, Rudy. Philip van Dijk from FN Arena.
It was a pleasure, James.
Good. It was a pleasure. It was great. It was great to get your views, and we will have you back, Rudy. Hopefully, if you'll have us. So thank you, everybody. I'm James Kirby, Wealth Editor at The Australian. Talk to you next time.